Hey everyone, today we're going to do a video to talk through how to refinance rental property. In this video, we're going to do a high-level overview of what the process of refinancing a rental property looks like, and to kind of talk through two kind of main ways that you can go about getting it done. First of all, just like buying a house, if you ever dealt with the purchase of a home or the refinance of your primary residence, you can do a very similar process with a rental property. That process is what we would call your conventional kind of stuff, like a VA kind of loan offering. There's a lot of different types of loans that are in the Fannie Freddie world. We'll call it Fannie Freddie world over here on the left-hand column. This is where you are doing traditional qualifying for the loan for the rental property as a refinance this time. So this instance is going to include like your tax returns, your credit score, basically your income and state as a financial independent person is going to qualify you for this loan. So they're not going to really even care about the income from the property. As a matter of fact, many times they won't even use it. So you just qualify for it. Like if this is your second property, this will just be like you having a second mortgage on like a different house. That's one way that you can go about doing this. One that I want to really dig in on today a little bit with you is the idea of, or the loan product offering of what's called asset-based lending. So the big nuance between these two properties, or these two loan offerings, is the way that the bank goes around assessing the approval of the loan. So in the Fannie Freddie world, you are going down a path where you are largely getting approved for this mortgage based on your financial position. In an asset-based loan, which is a little bit more unique, you're typically going to find these with local banks or even institutions that are outside of like a normal kind of banking world. These are going to be loans that are based on the performance of the asset. And in this case, it's a rental property. So the way they go about allowing you or approving you to get the refinance done is going to be based on how that asset performs. So there's a couple key indicators that you'd want to know for this. First of all, they are going to still do a background on you. They're going to look at your credit. They're going to look at your personal financial statement. They're going to want to make sure that you're not a bad person to lend money to, because it's their prerogative to make sure that they're in a good spot. So they're going to check you out. Once this is kind of done, though, you're pretty much set for a while. Sometimes they'll re-up every year and kind of check in and see how things are going. But largely, you kind of check that box to kind of get into this lane. The next thing they're still going to do, there's still going to be an appraisal involved. So this is just unavoidable. Everybody you're going to borrow money from is going to want to know what the asset is worth from a third party. It's unfortunately often the case. We always think that what we own is worth more than what it is. So it's a third party verification of the value of the asset. This will then this will tie into what comes later as a loan to value. We'll put LTV here. Loan to value essentially means the amount of debt that they're willing to put in place on that asset. So oftentimes this in this lane can be anywhere from 65 to 80%. In this instance, on the loan to value, they could have, let's just say the home is worth $100,000. They would then give you a total loan amount of either $65,000 to $80,000, depending on what their product offering is, and that varies based on institution. That's just going to be the way that they dictate that, and that comes out of the appraised value. The other thing that they will still limit this, and this can also reduce the amount that they'll allow for you to refi out, is going to be what's called a debt service coverage ratio. This is kind of a tricky little term, but there's a way that the institution will base it on the performance of the asset. So what they'll do here, this is a little unique, instead of just accounting for your income in the approval of the loan, they actually will essentially do like a profit and loss for the asset itself. So let's just say, for the sake of this example, that you have PITI on your home, which is principal, interest, taxes, and insurance, that totals, let's just say for easy math, $1,000 a month. When you're getting approved for a asset-based mortgage, if their debt service coverage ratio is 1.2, that essentially means they're going to be asking you to have 20% profit above and beyond all your expenses for that property. So for this example, we have PITI at $1,000 a month. That essentially means that they're going to be looking for you to have a minimum rental income per month of $1,200. That's 20% above and beyond your costs. So if you want to go ahead and get this type of a loan product, you got to go through all these processes. So you're going to have to get it appraised. You have to figure out the loan to value they'll work with you on. You have to meet a debt service coverage ratio, and then you have to ultimately get it rented out to do that. So if you're doing to make sure that you have the property completed with renovation so that it can be appraised at the full value, because they do as-is appraisals at this point, and you need to make sure that you have a signed lease in place with a tenant in place paying you rent. they need to oftentimes see it hit your bank statement or something like that so that they're going to actually know that the income is being made. So this rent is not just like a pie in the sky rent. This is actual rent collected. Hopefully this video has been helpful. I hope that, or if you have any other questions, feel free to comment below. We're happy to share the tips and tricks that we've learned along the way on how to scale and build your rental portfolio, and we'd love to get to know you more. Comment below. We'll talk to you soon.